Okay, so that is recording. Awesome. Okay, so my name is Jimmy. I'm also Jimmy1776 in Option Goats Trading. First and foremost, here is our channel on Discord on the server. Now today I'm going to make a debit spread crash course. Now there are 3 or 4 different reasons why I am a firm believer in debit spreads. More importantly, towards people that might not have as much money in their account. You know, I'm talking about sub $2,000 in their account, and you know, I get a lot of DMs saying like, well, I bought this call and I bought this put, and it cost me like $500 or $600 to do the play, and then I lost it. It's like, whoa, okay, that's like 25% of your portfolio. You know, that's a lot of money. If you do a debit spread, that's, you know, you still can use the technical analysis that you need to do, price targets and all that good stuff, and still make just as much money, if not maybe more, and do more plays and get more hands in the cookie jar and all that good stuff. So, you know, I did a first crash course before, so this one is going to be, you know, 2.0. You know, join our server, Option Goats Trading, right over here. Now, we do have an Instagram, Option Goats, right here. You can see it's got the ram on it, the goat, goat ram. Very cool. And then we do have a YouTube channel, but it's not posted yet. It will be up and running like soon enough. Make sure to give our Instagram a like, follow it on here. So I asked the general chat what would be normal questions that new people would have on debit spreads, and the first person said, what is a spread? I love it. 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 So let's just look up debit spread, profit and loss real quick. Boom. Look at this. I love it. Okay, so if we look right here, so real quick, without me explaining what options are, just know that in a debit spread, you'll always pay an amount, right? You'll pay a debit, okay? And you can only lose that debit. You cannot lose more than that debit, no matter what. If you do a debit spread, you're never gonna lose that amount. And then there are gonna be 2 different legs, right? When it goes over the second leg, that's when it makes more money, right? So that's a debit spread in a nutshell, okay? If we go to, let's go to say Apple, okay? So first and foremost, this is my Robinhood account. I'm gonna show you. I spent a good amount of money of this past weekend, so I actually had a lot more in it before the Friday, you know, before yesterday, which was Saturday. I was using my Robinhood account a little bit more than I should. But for instance, I am a long-term investor, so I like to do long-term debit spreads. I have a long-term portfolio that has about $25,000 in it, and then I had about, you know, I only put aside $600 or $700 in an options account. This would probably be about $4 or $5 grand had I never used my Robinhood account. So if there's anything you learned quick, is that do not use a Robinhood account. So let's just use an example. Apple's pretty hot right now, so let's just use Apple as an example. So we're on Robinhood right here. So if you're looking into you know, options, you know, it's crazy. You need to learn how to use options on any platform before you can do a spread, which is kind of, you know, I wish you could learn the other way around. I wish you could learn debit spreads before options. So if you go to Robinhood, okay, so you go to your portfolio, let's say you want to mess with Apple, okay, right? So you go to Apple, right? Okay, you go to options, most of you know how to do. And let's just pull up an example right here. So you've got calls, right? You've got calls. If you're bullish on a stock, you can go calls. If you're bearish on the stock, you can go puts. More importantly, let's just look at an example right now. So let's look, so somebody asked, what is a spread? Well, you got to explain what an option is. And then I'm going to have to teach you what buying and selling is and what the difference is, because you got to really think about it. Okay, so, all right, so if we go to Robinhood right here, for this day, for the strike price. Okay, so the stock is at 460, right? 459.29, right? It closed at that. This option, right? So this option says that you can buy 100 stocks of Apple at a price of 460 at the expiration date of August 21st. So if the price of the stock goes past this, the value of the option will go up, because this price right here, 788, is per stock. You're paying that much per 100 stock. So if I pick this, I went all the way as far as this, one option would cost me $790. Why? Because it's per 100 stock, right? Each option says you can buy a specific stock at a specific time per 100. So just remember that. If it says 788, add 2 zeros. 788 bucks, right? Okay, so that's a call, right? And then more importantly here, if we go into Robinhood, right here it says what the bid was, what people were bidding it at, right? So people that were trying to sell it, people that were trying to get rid of it, right? They're selling for, buying. Oh my gosh, buying. And then people that are selling it are asking for $7.95. Excuse me, sorry, it's a little bit morning still for me. So the shows the previous close of the option, what the high was, what the low was. Volume will always be how much the option trades that day. You're seeing throughout the day, you'll see this number change, right? Because that many people are either buying or selling it. And I'll get more into that in a little bit too. Open interest will tell you how many open contracts there are, right? Okay. Implied volatility. So that in a nutshell just measures how crazy the stock gets. If it's a stock that, for instance, if you look at AMD, well, maybe not AMD anymore, but well, before it blasted off, let's look at it like this. It would stay in a range between 59 to 48. So if we went to AMD and went to options on AMD, oh man, I'm trying to think, maybe another, let's go to Coca-Cola. That one doesn't move very much. Look at that. Implied volatility is at 18%. That's really, really low. Because if we go to Coca-Cola, this is a stock that does not have a very large range. So its implied volatility is very low. Therefore, there's not a lot of volatility priced into the option contract. The more movement it gets, the more implied volatility it's going to get. So let's go back to that Apple spread. Apple option chain, the Apple call at 461. So volume, up interest, implied volatility, Greeks. So you have an option contract. Picture an option contract. Okay, you got an option contract. Now that price right there, 788, right? Per stock, per 100, paying 788 bucks. Okay, so delta. Think of it if you took, calculus. Derivatives were just saying that one thing is another thing. One thing is affected by another thing, affected by another thing, right? It's just, it's a silly way to make it sound confusing, but it's not. But if you took calculus, you can have a derivative of a derivative of a derivative. So for instance, an option, not to make it sound more confusing, an option is a derivative of a stock. Technically, this delta right here is something that is a derivative that changes a derivative of the stock. If that's, and I don't know if I said that right, but delta basically will tell you this will change the price of the option contract per 0.5. So if Apple stock goes up $1, this option contract will go up per whatever the delta is. Okay. All right, so now you're getting it. So delta changes the option contract, and the stock changes the option contract. Stock changes the option. Delta helps make the option go up. Okay. All right, here we go again. Gamma. Gamma will change delta. So for every dollar that goes up, not only does the option contract go up 0.5, the delta goes up 0.0198 for every dollar this goes up. Recap. Stock goes up $1. The option contract will go up by delta, and the delta will go up by gamma. Okay? All right. Now moving on. Theta. That's your time decay. There's a negative there, right? None of these have negatives except this one. Theta is your time decay. So every day that goes by, your option contract will lose theta. So if it's 0.5762 times 100 stock, that's $57. Every day that goes by, this goes down by theta. All right, so recap. If the stock goes up by $1, your option contract will go up by delta, and delta will get higher by gamma minus whatever theta is. Theta is not charged at the end of the day. I've got that question a lot. It's not charged at the end of the day. It's divided by every second throughout the whole day. Every second that goes by, that is a fraction of theta. It is constantly going. Does theta affect you throughout the weekend? Yes, it does. Does it affect you when you're sleeping? Yes, it does. It affects the option constantly. Kind of like how Forex trades, constantly, does not stop. All right, moving on. So okay, so we got delta, gamma, theta. Those are the main ones that you really need to know. Vega, you need to know what Vega is. You need to know implied volatility in certain situations, in certain spreads that you do. But just know that Vega, for every percent that moves up, Vega is going to affect the option contract to go up by Vega. So if this implied volatility percentage goes up by 1%, the option contract will be bloated 25 bucks. I say bloated because, you know, leading up to ER earnings, option contracts usually get bloated, and then right after they deflate. So they get pumped and then they get crushed. You'll hear that term a lot for people that like to play earnings. Row, that's just based on interest rates. I'm not going to even go over row right now, but it's just know it's based off interest rates affecting the option price, but I won't even worry about that. Okay. All right. So now that we've gone over the call option, I'm going to give you a quick overview on the put option. Let's look at the 455 put. So the bid 580, they're asking for 595, the mark, okay, close, high, low, volume, open interest. Oh wow, okay, so yeah, the same as we call, right? Not as much open interest though. Not a lot of people bearish on Apple, which I mean, there's no, you know, that's a very bullish stock, right? So and then down here, delta is negative, right? So let's see. So every time the stock goes up, the delta affects the option. So the stock goes up, we're losing value, right? It's a put option, meaning that we're bearish, saying that we want the stock at 455 at a certain price on August 21st. The stock is at 459, right? So this one's saying you can buy it at 455. For every time it goes up, it loses value, right? Because you want it to go down, right? So it'll lose $40 per day if it goes up. Excuse me, it'll lose $40 per dollar that the stock goes up. Gamma affects it. Theta, you start losing on theta, and you got Vega, right? All right, so we got the put option. Same thing as the call option, except you got to think reverse. All right. Now, if I were to do, let's use an example. Somebody in the chat used an example. I think it was, somebody did a Williams-Sonoma play. Oh, here it is. Champs, one of our moderators, has a call debit spread that expires on Friday. Today's Sunday, by the way. It's 8/16/2020. On Williams-Sonoma. It's an 87.50 95 call debit spread. Looks like she bought it for about 260 bucks. And it looks like right now she's at about almost 100% return on it, which is awesome. That's great. Expiration is 8/21. And that's about it. So let's look at that. So 87.50 95. So here's Williams-Sonoma. We go to options. Let's go to the spread that she's using. So what she is doing, notice how the stock price is now in almost past her second leg, but this is the way she set it up. She went to 87.50, right? To call debit spread, meaning that she's bullish on it. She is buying the 87.50, and you go up here to sell, and she is selling the 95. Okay? Think about it this way. When you buy an option, somebody is selling you that option. When you buy an option, you are saying the opposite of what that person is selling it to you for. I'm going to repeat myself a little bit because it's going to work, I promise. When you buy that option, you want it to go up. The person that sold it to you wants it to go down. Just think about that for a second. Think about being on the other side. There's always another side. If you're selling, somebody's buying it. When you're buying it, somebody's selling it. And somebody wants the complete opposite of what you want. When you're bullish, somebody else is bearish. Every time you take a position that you're bullish on, somebody's bearish. Think about that for a second. Okay. All right. So we're looking at this call debit spread. She bought it when it was, let's see. She bought it when it was 260 bucks. So let's see. And how much time do we have here? It doesn't say, but that's okay. So, so the way that this works, when you do a spread, when she's buying the 87.50 and you're selling the 95, you are gaining more value on the bought option than the sold option. When you buy this option and sell this one, you gain this one and you lose money on this one. The reason for that is that if I were to be bullish on Williams-Sonoma, that option was probably it was probably expensive. It was probably about $400 or $500 when she bought, if she were to just buy the call option, right? But she didn't want to do that. She wanted to do the debit spread. So she's buying the 87.50 and selling the 95. Think about it this way. When that stock was below the 87.50, when it passes through the 87.50, it gains more delta faster than if the 95, faster than she loses on the 95 call option. Okay. So when that stock passes the 87.50, she is now gaining more money in the bought option than the sold option, right? Because as you become more in the money, your delta becomes closer and closer to 1, right? That's just something that, you'll learn as you go. Because as the options are far out of the money, deltas are smaller. As you get closer in the money, the deltas are higher. Okay. So here's another thing too. When you are looking at a debit spread, a lot of people ask, like, how do I figure out profit loss and like calculators? How do I do that? You can always go to profit loss calculators options profitcalculator.com, and it's got all the options here for you. Okay, you can go to long call, or excuse me, you can go to 2 legs, you can go to Williams-Sonoma, right? We're buying the 87.50 call, and we're selling the 95. Calculate it. Oh, and it says risk, so you want to make sure you go down. Oh, no, that is profit or loss. I think it's because it's more in the money right now. No, it says. So you can lose more money on it because she made this play, a week ago. So you can still make $162 more on it, is what it's calculating. But this will calculate it for you. You can use that, or you can do it this way. Think about it this way. When you have a debit spread, and let's say this Williams-Sonoma goes past 95, right? And it expires. You are exercising the 87.50 option, meaning that you're going to take the stock, you're going to buy the option, right? Or excuse me, you're going to buy the stock. You're going to exercise the stock, but you are being assigned the 95. So what does that mean? Okay, well, let's see here. 87.50 is the strike, and 95 is the other strike, and it's per 100 per strike price. Okay, so that means, okay, 100. Okay, it's 100 per dollar. So that's 500. That's another 250. Oh, that's 750, right? So if we look back at Champ's trade, 260 was what she paid. So since she knew when she did the spread, that's $750, right? Max credit. If she lets that expire and she gets full profit, she will be cashing out in total 750. Not profit, she'll be cashing out 750 total. If she paid 260, she's okay, so she's getting 750 minus what she paid. So she's profiting 490. Right now she's profiting 242. She's probably going to hold it and let it ride so that way she can get most of the profit there. Okay. If she would have done, instead of this 95 and do the 92.50, then you would have 500 max credit. She wanted more money, so she did it that way. So let's see here. I'm going to go over. So I went over the spread. Somebody is also asking about the put debit spreads. Also very good example. So here's the other thing too. When you do a debit spread, let's look at, let's just make a new one with Williams-Sonoma. Let's say you bought the 97.50 and you sold the 100. Okay, I'm not bullish on Williams-Sonoma. I don't know anything about. I don't know anything. I'm not saying that her play was bad or anything like that. But when you buy, you always want to make sure that when you do a debit spread, the bought option always needs to be closest to the money, to the stock price, because you want that one. You want to be benefiting more on the one that you bought, not the one that you sold. If I were to go here and I was going really fast, I said, you know what? Oh yeah, okay, 100, and then 97.50. Jim said that in the crash course. Wait a minute, this is credit spread now. What did I do wrong? The sell is closest to the money. That's the problem. If it says credit spread, do not fill. This is the opposite of a debit spread. If you sell a credit spread, somebody else is buying it, right? If you buy a debit spread, somebody's selling you a credit spread, right? You're buying a spread, you're selling a spread. Boom. So if it says credit spread, this is the awesome thing about Robinhood, is that it'll always show if it's a credit spread or debit spread. So you can always check yourself before you fill it. So if we go to puts, same deal here. If I'm bearish on the stock and I buy the 92.50 and I sell the 87.50, that max credit is 500, right? Because it's 92.50, 87.50. I'm paying 90. So let's say the stock goes from 94.58 and goes to 87.49, expires at 87.49. I get 500 credit minus the 90 I paid, 410. Easy. That would be your debit spread. Okay, so let's see. I got the intro for you guys. The benefits. I'm going to go over the benefits again. So when it comes to spreads, let's say I wanted to do a debit. I have about 5 debit spreads. Well, actually, let's look at. I know there was another mod that had a spread. I think it was Corn. Corn has a Tesla spread. Ah, yes. Let's do this. This is a perfect example. So he has the 1950, or no, excuse me, the 1980 and the 2000 call for Tesla. So let's go to Tesla. And he's got 918. This is a good example because I have a split. So that way I can go over that too. So 1980 and 2000. Okay. So this is what Corn is saying. if we look at the chart, actually, well, it's getting split. I'll make it make sense. It'll make sense. Okay. So here we have Tesla. I use TradingView, by the way. So does Alec. If we go to Tesla, he is bullish on the stock, right? So if you're bullish and you want to do a spread, you want to call debit spreads, right? Same way if you want to do calls. But he probably did not want to spend $4,798 to buy a call, right? That's a lot of money. That's a lot of money. That's a lot of cheese. But he says that Tesla will be over 2,000 by September 18th with a debit spread. He's buying the 1980, selling 2,000. So the stock, let's see if I remember, Tesla split August 28th, and it's a 5-way stock split. So if, and let's eyeball this real quick. If the stock is over 2,000 by the expiration, the stock, the max credit will be $2,000. Right now it's priced at $240. Okay. It's a 5-for-1 stock split. So 400. So after the split in August, his sold leg will be a 400 call, and he will have 5 of them. For a forward split, they will split the stock up on the option price. You won't lose value. You'll actually get more option contracts from what we have been reading. A lot of us have not gone through a forward split with options because typically stocks go through reverse splits, not forward splits. So it's a good thing, but something that in my trading career, I have not gone through because it's been a while. So he'll get 5 of these, and he'll get 5 of the bought leg as well. Okay, so he's holding that. And those are pretty good odds, 240 bucks to make 2,000. Now, let's see. Why not use a contract further in the future that is cheaper all the time, even if it's far out the money, like the Apple spread we're in? Everything close is expensive, but not further out, and we're way out of the money in that one, but I'm still showing a profit on that. I hope that kind of makes sense. It did make sense. So for example, I will use my Apple spread as a example here. So let's get out of that, let's get out of that. We'll get in this. So if we go to Apple, okay. So I am bullish on Apple, right? Okay. So I want to make a debit spread on Apple. Okay. So I'm going through Robinhood. Okay. I'm going through Robinhood. I'm looking at these options. I'm like, oh man, that's like 580 bucks. That's a lot. That's a lot. Man, if I even want to get it around at the money, that's like 800 bucks. That's a lot. I don't want to spend that, but I want to mess with Apple. Okay. Let's see. Apple has their stock in a couple weeks. I'm bullish on the stock, but I want to go out the money, and I want to make a lot of money. I might not win on this though, but I want to go out the money. I want to make this very cheap. So what am I going to do? Let's see. So I'm going to buy the 640 strike price for March of next year. And I'm going to sell the 660. Okay. I'm going to buy 5 of these. It's going to cost me 690 bucks. It says debit spread up there, March. So that's going to be, after the split, I'm going to get 165 on the sold leg and 160 on the bought leg. And I'm going to have 10 instead of 5. Now let's see, one spread, if it passes the 660, one spread is, let's see, that's 20 strike prices. That's 2,000, right? 100 times 20 is 2,000. I have 5 of them. 5 times 2,000, 10,000. If this spread makes it over by its expiration, I will have a max credit of 10,000. And it cost me $697. It's for March. That's a long way to go. But that gives Apple a long time to give it a chance to keep going, right? And I'm pretty bullish on Apple. I've always been bullish on Apple. So that's the way I do my long-term debit spreads. I go out of the money, I get a good amount, and I receive that credit. Do I lose? Yes. I mean, everybody loses, right? But when you do get the winnings, I mean that's awesome. So let me see, maybe somebody put other questions in there. FedEx spreads. Okay, I think that's about it. I'm trying to think if there's anything else. So recap, go to Robinhood, Apple debit spread. Remember the bought option. Let's say I'm bearish on Apple, right? I would always buy whatever the option that you buy, it needs to be that's closest to the stocks. If you sell an option, that one needs to be further than the one that you bought, right? So remember that. And then just remember, if you ever switch them up, you actually accidentally put a sell closest to the money, it's going to say credit spread, which you don't want that. You want debit spread, right? Let me see if there's anything else I can bring up. Just remember, all the options that are closest to the money are going to be more expensive. Deltas are going to be higher. More out the money, delta is going to be lower. They're going to be worth less. You usually want to buy them cheap, right? You don't want to go way out the money where it might not even hit. Also remember strike prices, right? So I said $5, every strike price is $100. So, if you were to go to SPY, for example, and you just made like a weekly debit spread, which I wouldn't recommend doing. Every dollar is $100, right? So if I go out the money on a call debit spread, I buy the 339, sell the 341, that's 200, right? Because 339 to 341, that's 200 minus what I pay, which is 53. So that's like 150, 147, right? Let's see. Trying to think if there's anything else. I think that's about it. That's it for debit crash course. Just remember, if you use Robinhood, it'll tell you if it's debit spread or credit spread. Always feel free to contact the mods at Option Goats Trading. We all can help you, whether it's Robinhood or Thinkorswim. I can do Thinkorswim. If you need help, I can always walk you through it. It's a little bit more confusing. That's why I like Robinhood for spreads. For my long-term account, it's my long-term account is just TD Ameritrade, and I have a full line of stocks that I'm in, and I always list them at the end of the day. I'm trying to think if there's anything else. Just know that, remember, when you're buying an option, somebody's selling it to you. Somebody wants the complete opposite. When you do a spread, somebody's selling you that spread. When you sell a spread, somebody's buying that spread, thinking the complete opposite as well. So awesome, guys. If you have any questions, feel free to contact me. And if there's anything else that you guys need, like I said, I'm more long-term spreads. Alec is day trades. Champs, Spike, and Corn, they all go long on puts and calls. They do spreads also. Brady will do more spreads and calls and options coming up here. And then I'm more long-term, period. When it comes to what kind of plays I do, they're all long-term. They usually 6 months out, maybe even longer. I have a play that goes all the way out until 2022. So you'll notice the other guys will be more medium-term, from 15 days to 45 days, maybe 60 days, but typically I'll be more than the 60 easily. So thank you, guys. And if you have any questions, comments, concerns, anything that we can do better here at Options Goats, let us know. Like I said, on our Instagram, give us a follow there. Got some pictures there. OG option goats. I love that ram. It looks so sick. Fire. All right, guys. Well, if you have any questions, feel free to shoot me a message, give me a call. We also have the one-on-one channel. Don't be afraid to message one of us, and we can hop on in there. We can share our screen. You share a screen. Ask us any question that you have on any kind of spreads. You know, what Greeks are, how to use technical analysis. I didn't go over technical analysis on this just because this is solely for debit spreads. But other than that, that's about it. So perfect, guys. Well, thank you so much for watching this video. If you have any questions or anything like that, give us a reach, and then we can go from there. So thank you, guys. Keep trading. We'll talk to you soon. Have a great day.